Hey, party people. In this week's Money News in Human Words, the first thing that came onto my radar was this story on the 5 worst super funds being revealed in Australia. And collectively, they manage over $20 billion in investor funds. Now, 4 of the top, these 5 worst performing super funds were on the list last year. And this has actually resulted in them being banned from taking on new members, which is pretty staggering, particularly given the size of some of these funds. Basically, the list is the top one is the BT Super My Super option in their retirement wrap fund. That fund manages over $21 billion of member funds. So it's the biggest one on the list. We've also got Australian Catholic Super and Retirement Fund, their Lifetime One option, the Westpac Group Super Retirement Wrap, Energy Industry Superannuation Scheme, and AMG Super. And Energy Industry Superannuation Scheme, or EISS, is currently seeking approval from the courts to use super fund members to pay fines levied against its directors. So it's really no surprises that their fund is not doing so well. But essentially, this test is something relatively new. It kicked off last year and is the government's way of pushing poor super funds out of the super system. It basically tests how their default options have performed over the past 8 years, adjusted for fees relative to a benchmark. And so they look at what a fund should have performed, and if it's underperformed by more than 0.5%, then the funds are deemed to have failed. So these laws require that the funds that fail the test, they send a standard letter to their members telling them that their super is sitting in a product that's performed poorly, and suggest them to that they can look for a well-performing fund on the government's comparison tool. So last year, 13 funds failed that test and 10 have exited the system by merging with another fund or are currently planning to do so. So there's basically millions of members within these funds. So it's always worth doing a comparison and making sure that you're getting the best deal for your super. I think that this move from the government around this test is definitely, though, a prompt in the right direction to help Aussies with their super. Next piece was around house prices falling as lending has hit a decade low. Basically, new property loans are down 8.5%, which is the fastest decline in loan approvals in 2 decades. And looking at the price drop from the peak of the property market, Sydney is now sitting at a 7.4% decline from the peak, Melbourne 4.6%, Brisbane 2.6%, Adelaide 0.1%, Perth 0.2% down. So Sydney is clearly leading the charge, Melbourne not far behind, and then you got Brisbane, Adelaide, and Perth that are playing a bit of catch up. Capital cities combined are down 4.2%, and regional is down 2.2%. So I think it's worth noting that some areas of the market, some pockets of suburbs and properties are holding up strongly, and not all sectors are feeling it the same. But with new loan approvals way down, it means that there's now less people in the property market. So it suggests that potentially there's some more falls to come there. What that means is there's an opportunity out there for smart buyers. But if you're going into the property market now, given where the markets are, that you want to really make sure that you've got your eyes open and your plan is rock solid to make sure you actually get the results that you want when you do invest into the property market. The next piece that I saw, and I suppose in some positive news, that Labor has come out saying that they are going to support the tax cuts that were slated to kick in July 2024, that are slated in July 2024 to kick in, basically meaning that people that are earning between $45,000 and $200,000 a year are going to be paying no more than 30% tax on their income. And what that means is it's going to be much easier to build financial freedom, financial security much faster, particularly if you're building income from investments. It means that you're not paying, too much tax on that money. Also, there's a really, for high income earners and for people that are saving strongly, there's a really powerful strategy that I think like it will work really well with these tax cuts around using a trust and investment company to build your wealth, where the reason that strategy works well is because your tax rate ends up being capped at the company tax rate of 30%, meaning that you don't pay any more than 30% tax on your investment income while your investment income is building. Then when you choose to not work and you're not generating a salary for other sources, it means that you can basically draw $200,000 a year or up to $200,000 a year in investment income. And again, you're not paying any more than 30% tax, which is pretty amazing. It means that there's a massive strategic opportunity there to get things lined up and in place today, because this sort of strategy takes a few years to build. And by the time these cuts start coming through, by the time your investment income rather starts pumping, the tax cuts will be coming through. So like I was looking at some numbers, and if your goal is to build, say, $10,000 per month of passive income from investments, the tax saving from following this approach is over $20,000 per annum, which is $20,000. It's actually growing your investments faster. So worth understanding the rules, how to use them to your advantage, because tax is the biggest opportunity for investors to actually get ahead faster. Another piece that I was looking at last week was around how Mike Cannon Brookes is spending his $1.5 billion green fund. He's basically carved out 10% of his $15.3 billion in wealth as at the time of putting this together to start a $1.5 billion fund supporting environmentally friendly projects towards the ultimate aim of cutting emissions by 2030. Now, the first push from the fund is into electric vehicles and the electrification of homes. And this investment arm that he's basically created has just launched the first ever electric vehicle summit. The fund will drive impact investing, and in the same time using it as a platform to drive awareness of issues. Basically 2/3 of the $1.5 billion is to be invested into for-profit ventures, with the remaining $500 million to drive advocacy and non-for-profit investing. But it's amazing that I suppose money makes money, because while he's doing this from an impact perspective and social good, and like, well done, good on you for doing that. You know, if we look at things like the growth of the electric vehicle market over the last little while, he's probably going to be doing some good for the planet and making a bunch of money in the process, which always good when you can get those two things aligned. Continuing on the sort of tech firm and tech sort of bent, and talking about the fact that VC capital funds are acting a little bit wise at the moment, as a bunch of people in tech startups are getting fired. These venture capital firms are starting to turn off the tap to the startups that they were falling over themselves to fund while money was cheap over the last little bit before the RBA has started increasing interest rates. And as a result, we're seeing a heap of startups that have undertaken significant layoffs. Companies like Mr. Yum, Sendle, Bright, Eucalyptus, and a whole bunch more are cutting significant portions of their workforce. And what the commentary is, I was reading this article and it was pretty scathing of venture capital firms. Obviously, the journo has a bit of a bent against them, but talking about the fact that these companies, the venture capital firms, are now talking about, like, you know, profitability and cost control and capital control and all of these sorts of things, which makes a lot of sense. But they were saying that they should have had this focus a lot sooner than now. So the massive flows of VC cash are being blamed for overly inflating salaries in the marketplace, and in particular for the tech workers. But what we're seeing at the moment, particularly with the ultra low unemployment rate, doesn't seem like that's anything that's going to change in the short term. There is still a lot of money out there. A lot of firms are getting still funded and getting considerable amounts of funding, but it is getting harder to come by. I think it will take some time for the market to recover. And for me, for investors, for ordinary investors out there, it highlights the fact that for early stage investors in particular, these sorts of investments are something that can take a lot of time, and unexpected events like, you know, the current conditions that we're seeing in the economy can significantly delay you actually earning out from your investments. And I see a lot of people that get pulled into the allure of startup investing, and I get it. Like, it's exciting, it's interesting, there's potential to make a lot of money, but things can change quickly. And it means that even if your investments are performing well on paper, you're not necessarily going to be able to realize any cash out of those investments until the market conditions mean that it's appropriate to do so. Another really interesting thing that I was looking at last week was the Ethereum merge, where it's talking about a merge of the Ethereum blockchain, which is expected over the next couple of weeks. It's essentially going to allow holders of ETH to earn a yield for helping validate the network, which has prompted DigitalX, who are one of the major players in the crypto space, to sell down on Bitcoin and instead buy Ether. So basically, obviously it gets pretty complicated with the tech and stuff that sits around this, but essentially by reducing the need for computer power, to validate the network, the upgrade is going to cut the use of Ethereum's energy by 99.9% and leave Bitcoin as the only blockchain technology using proof of work concept to update its blockchain. What this means is that Ethereum's supporters are saying that it's going to create a decentralized world computer and allowing people to transact without using any intermediary and using these smart what they're calling smart contracts to execute tasks which make commerce more efficient. This proof of stake system allows people that have got more than about $50,000 worth of ETH to be chosen to select new blocks and update their network, and they get paid in new ETH as compensation for that. Talking about a yield of about 4.5% from being a validator, and that's caused a bit of movement in the market. That Bitcoin holders are selling out to move into Ether. DigitalX has done that, which I mentioned, and they've gone up like 20% jump on their share price over the last little bit, which is pretty big given that they've got a market cap of $40 million. And even though Ether has lost 55% of its value, it's up about 60% off June lows. So it's starting to really turn the corner. Basically, it raises a bunch of questions about future regulation and whether Ethereum would be considered as a security under the laws as opposed to a commodity, which means that it could be subject to tougher regulations. Probably, though, that's a good thing in that as the market starts getting more regulated, it means that it becomes safer and more of an avenue for more investors to get involved. It is leading to a lot of speculation as to whether Ether is going to take over Bitcoin as the preferred cryptocurrency, which seems to be a move in that direction. I think Bitcoin is going to be hard to dislodge, but it's definitely got a lot of people talking about that as well. The last piece I want to leave you with for this week is around how to, I suppose, the power of time and the power of getting started, but why those first steps are the hardest when it comes to investing. I want to share an example which talks about how long it takes to build your first $100,000 through investing versus the next 100. So a lot of people think that you need a lot of money to get started investing, but you really don't. I've got this example where you start with $0 today and invest $500 every week. Basically, if you do that, and appreciate that saving $500 a week is a pretty solid clip, but it would take you 3.5 years to build your first $100,000. But then things start getting easier and easier. So the next 100,000 only takes 2.5 years. Then the next 100,000 only takes 2 years. The next 100,000 after that takes 1.5 years. And you keep that going. By the time you get to year 15, your investments are now increasing at $100,000 every single year. By year 23, it starts increasing at $200,000 every year. Year 28, $300,000 a year. And year 34, $500,000 a year, until ultimately year 42, your investments are increasing by $1 million every single year by just putting in that same $500. And this is the power of compounding and the power of time. As well as the power of getting started. As I say, you don't need a lot to kick off, but you do just need to be consistent and make it happen. The results are obviously worth it. Guys, that's it for me for this week. I'll catch